So you would have seen the retail sales data came out a couple of days ago, and once again we hit a record high, so up 12% year on year in June. So this really puts us at odds with what we're seeing in other parts of the world. Greg has mentioned Germany this morning posting negative data. The UK is negative. The US has slowed, although remains positive. But in Australia, we keep going from strength to strength and continue to accelerate. So this is a bit of a retail paradox at the moment, because what we're seeing in the stock market is anything but positivity. The retail index has fallen by almost 30% since its highs in August last year, and of course is tracking consumer confidence, which I would just remind you is an indication of what consumers say they're going to do rather than what consumers actually do. But nonetheless, we're down at levels that we haven't seen apart from the early onset of COVID since the GFC. So clearly there is a difference of opinion here. So if we move on to the next one, that's perfect. What is going on is Aussies are still shopping. They are getting out there in increasing numbers. We're back to almost pre-pandemic levels in footfall in shopping malls, as you can see from the chart on the left. And online sales, which certainly they've come off their highs that we saw this time last year when the fine city of Sydney and Melbourne were in lockdown and people were shopping online. We've come off those highs, but we're still well above where we were pre-COVID. So really, online sales have doubled since the pre-COVID times, and we're up to 11% of all retail sales happening online. So the consumer isn't stressed. We're seeing that household savings are still well above where they were before COVID. Now, they are coming off because clearly there are things to spend your money on, and so we're starting to burn through those household savings. But you remember the numbers being thrown around about the savings that Australians put away during COVID. They haven't all been spent. They're there, and consumers have money. And the unemployment rate, as Tim was just talking about, is close to record lows at 3.5%, and 500,000 job vacancies in Australia at the moment, and there are 500,000 people who don't have a job. Now, that ratio is usually 3 to 1. So right now, we're effectively at full employment. It's not to say that everything's positive. Yes, sales are holding up for retailers, but the input costs are certainly coming up. Wage growth is accelerating. Of course, the minimum wage hike will put further upward pressure on that as we look to counter the rising cost of living. And also freight. You can see just the extraordinary increase in freight rates at the onset of COVID. Now, we're 30% off our highs in terms of spot freight rates, but we've still got a long way to fall before we get back to pre-COVID levels. We're four times where we were before the crisis. The next slide just talks on valuation. So are we cheap yet? Well, I've looked at the last 10 years forward EBITDA multiples of some of the larger and more liquid retailers in Australia, and we are at 10-year lows. So 5.5 times is the average 1 year forward EV/EBITDA ratio for these retailers, and that is 34% below the 10-year average. So clearly there's value in this sector if people choose to seek it. Moving on then to reporting season, which starts for us next Friday on the 12th of August. We, as you can see here, have a mixed bag of expectations in terms of EBIT growth. The best growth is really in those companies that have international exposure, so have largely they were largely through the worst of the COVID lockdowns when we came into FY22. So companies like Lovisa, companies like Breville are going to do best. The ones that are going to go backwards in FY22 are those that have been affected by those 188 days of lockdown that we saw in the financial year that's just finished. So domestic companies like the Reject Shop, Accent, Universal Adairs, these are the ones that are going to be showing negative earnings. But in terms of the positive and negative surprise risks, we do think there's good momentum in companies like Super Retail, in Beacon, and of course in Lovisa, which I'll touch on in a minute. But I'd be concerned about companies like Reject Shop and Domino's as well. Reject Shop because of the transition that it's going through, and Domino's because of the effect of the yen on the margins in Japan. Moving on to the next slide, it is looking much more positive in FY23. Despite all the negativity we hear about the outlook, we do have an expectation that earnings growth is going to be positive for our Universal stocks in FY23. In fact, we've got an average growth there of 19% of EBIT. And we are below, as you can see, we are below consensus on most of the companies that we cover. So consensus expectations are for an even bigger jump. Now, this, of course, reflects the fact that nobody's expecting to see another 188 days of lockdown in FY23. So despite the fact that expectations are reasonably muted when it comes to like-for-like sales, for example, and margins, the fact that we've got, or we expect to have, shops open year-round is going to have a big positive impact on earnings. So despite the negativity, the chances are company is going to be reporting positive growth. And they'll be doing that off the basis of reasonably strong balance sheets. So the scatter chart here just shows you gearing, or at least interest cover, and inventory balances. And you can see that with the exception of the Reject Shop and Accent, everyone's got more than 5 times interest cover. Inventories are reasonably lean for most companies. They are higher for companies with a slow sales cycle or slow inventory cycle like Beacon and Breville. But only really Supers and Accent, I would suggest, have perhaps got a little bit too much stock at the moment. So moving on then to some key picks, and there are 3 to talk to. So Lovisa, Breville, and Universal Stores. So if we can move on to Lovisa. The subtitle here is "It Might Just Work." So what I've been looking at is, if you recall, when Victor Herrera, who's become the CEO of Lovisa, he was brought out of Inditex, where he was the CEO of the Asia Pacific region, and was responsible for taking their flagship brand, Zara, into India and China. So thinking that there's method in Brett Blundy's madness, I've looked at the history of Zara. And we're tracking here the growth profile of Zara's store network compared to Lovisa's. And then just for fun, I've time shifted it by 16 years and overlaid the two. And mysteriously enough, they are very, very similar. Now, of course, I'm not saying that we're necessarily going to see Lovisa follow exactly the same path as Zara did. But of course, 16 years ago, there would have been plenty of Spanish investors that were looking into their coffee and chewing their paella and saying, look, I don't think that Zara is going to get to 1,000 stores, let alone perhaps the 2,000 stores that they ended up getting to. So maybe it could just work. Next slide. Goes into a lot of detail. I won't sort of go through all of this for you, but basically what we've done here is we've looked at all of the countries that Lovisa's been in for at least 5 years and looked at the store density in those markets, and then applied them to all the markets that we know Lovisa's currently in, including the ones that we've discovered that they've recently entered through nefarious means involving stalking people on LinkedIn. And so we know that they've recently entered Canada and Poland and Northern Ireland, and they're about to open in Hong Kong. So throwing all those countries into the mix gives us a total opportunity of 2,500 stores. They've currently got 630. I think that's absolutely reasonable. However, in our numbers, our base case scenario, which is really tracking where consensus is, we have them at 1,300 stores by 2030. Now, were we to throw in 2,500 stores instead, which, as I say, is not unreasonable given this analysis, we would have a 50% higher EPS under this scenario by 2030. That is a lot of positive sales momentum. So if this doesn't blow up, you could have a multi-year positive surprise story on your hands. Moving on to the next one, which is Breville. So everyone's favorite coffee machine is, of course, Breville, and they have consistently outperformed the market over the past few years. In fact, over the past 4 years, the average outperformance has been 17 percentage points compared to the broader global home appliances market. And they've achieved this miracle by increasing their expenditure on R&D, so making better stuff, and on marketing, so selling it harder. And so that ratio of marketing and R&D spend was 8%, when the current CEO joined the company back in 2015. He said at the time, look, we're going to crank this up to 12% and higher. As you can see from the chart, they're almost at 12%, and you can see the results of that. So I absolutely expect this outperformance to continue as we go forward, albeit, of course, the market is going to slow. Onto the next slide, which just talks about why I think that there's going to be positive earnings growth next year and positive sales growth. One of the reasons, of course, that they've opened up in a whole bunch of new countries, but one of it is really the effect of rising selling prices. And this is something that Breville has said to me, that across the board, they're increasing prices. And we had a look, or at least Leo had a look at Breville.com to see what they're selling their coffee machines for at the moment. And I'm slightly alarmed to report that the average selling price of the companies, of the stocks that we track, has gone up by 70% in the course of a month. So this Barista Pro coffee machine was $800 in June. In July, it was $1,400, and that is a pattern that's repeated across all of the products that we follow. And so clearly someone is paying this, but the point here is that there is significant inflation in the home appliances market, and consumers at the moment are paying it. Despite all this, Breville has been derated, so it's now 14 times forward EBITDA. It's still a high multiple stock given the growth, but it's significantly below, 30% below its 5-year average. And then on to Universal Store finally. So this is a fashion retailer focused on the youth demographic. And it may surprise you to learn that teenagers at least spend 20% of all the money that they do spend on clothing. And so there is a huge market for a youth demographic who are looking for clothes to take to festivals and parties. And increasingly, of course, we're in an unlocking and reopening phase of society. The festivals are coming back. People are returning to the stores to buy clothes. And there is an argument, of course, that the youth demographic who are perhaps a little less preoccupied by mortgages and the financial pages of the newspaper, and maybe even petrol prices. These are people who spend what they earn. And of course, once you get out of your teens and into the world of work, almost everybody is employed. And lo and behold, you're getting paid more than you were this time last year. And that money is finding itself in the coffers of companies like Universal Store. That said, the company is gaining good traction despite all this, despite all the competitiveness that we talk about in the market. And as you can see from the like-for-likes on the right, the average like-for-likes before the lockdowns hit were very substantial, an average of 17% like-for-likes. And we expect that to continue, albeit at a lower rate going forward. And then final slide, you'll be pleased to hear, just talking about their pricing and the outlook for store rollout. So Universal Store has very, very strong discipline around full price, and it contrasts with Accent Group that has been very promotional. And you can see the difference in the gross margins between Universal here and Accent Group, which have really diverged in the last year or two. And that is something which is going to position them well coming into a period of higher inflation. They're already at a point where they've got the consumer mindset expecting higher prices. And then finally, the store rollout is really the growth story with Universal. So there's around about 75 Universal stores around Australia, heavily penetrated in Queensland, less so elsewhere. And there are 3 Perfect Strangers, which is the female spin-off. They are all in Queensland. There's a significant opportunity to grow here. We do think that Universal Store, the company itself says they can do at least 100 stores. I've just put 110 here. Perfect Stranger, we think, could get to maybe about 50. That means that the store count could double over the next few years, which of course is going to give you a lot of underlying growth, which you're not paying for at 12 times PE. So finally, I've just come back from a week of marketing in Sydney, and I'm pleased to report that it was a very good hearing. A lot of people want to talk about retail, despite the fact that almost everyone's sold everything that they own in retail. There is a concern that they've gone too far. And I think the last few weeks have just reminded people that there's some quality businesses here at very low prices, and these can run. So when the mood of the market turns more positive on consumer discretionary, as it very easily could if we saw oil prices fall off and inflation start to moderate, institutions don't want to be unexposed to this sector. So people are looking for quality business like a Universal, like a Beacon, like a Super Retail that have been sold off in recent months, and could give you significant upside when the recovery finally comes, as it will. Cycles do one thing habitually, which is go up as well as down.